Officially, welcome to the December coffee chat. And like I was just saying, Anthony's here for the biggest news of the day, which is to tell us if the stock market is on Santa's naughty or nice list. But of course, we're also to ask questions, hear what you guys have to say.
Yeah.
By all means, everyone's invited.
We just saw your message, Patty. Thank you.
Got it.
We'll look forward to that.
That'll look good.
Yeah, well, if you want, I mean, I can just kind of start, or do you want to?
Well, I also wanted to just ask, who with the maybe raise a hand or write your name in the chat. Has anyone been to all 4 of our coffee chats this year? who are our lucky? I think Ann, Jeff,
Yeah,
yes, Jeff.
We have.
Jeff has been to all 4 of the coffee chats. A nice job. Well, we're very excited because then Ann gets some coffee from us, a pound of coffee from Engines Coffee. So thanks for all the coffee chats. We've loved having you here, Ann, for all 4 of them. And so we hope you can see everybody at the next coffee chats next year too. But with that, yeah, Anthony, I guess if you wanted to take it away, or should that be the suspenseful news to share?
Well, we could use it as sort of a jumping off point because, you know, aside from us talking about what we think, this is a chance for everyone on here to interact and ask your questions if you do have some. But, you know, to start off with, maybe the way I can phrase it is, and what everybody's wondering is if the market will be on the naughty or nice list next year, because I think it would not be a surprise to anyone to say the market's definitely been on the naughty list this year. And it has been an incredible challenge all throughout the year, starting almost exactly January 1st to today, where the market's up slightly today, and who knows if that'll hold till the end of the day. But it has been one of the more challenging years from a how do we protect, how do we sustain that, you know, really going back to, I would argue 2008 was the last year that was this challenging, or that was definitely more challenging. But it's on the naughty list this year because not even the conservative, the protection-oriented investments have done what we wanted anyone has wanted. And, you know, as the year has progressed, I've come up with a couple ways to think about this. But one of the ways I would describe it is this has been a year of bad markets, not necessarily a year of bad investments. And what I mean by that is we still believe a lot of the same things we believed heading into the year as far as what's worth investing in, what's worth keeping in a portfolio. And we've communicated that with all of you throughout your meetings this year. The problem has been the tide itself has lowered all boats. And I think we have one in the waiting room we can let in. But a rising tide, as they say, raises all boats. A sinking tide lowers all boats. And that's where we've been. There hasn't been a boat that has stayed above the January 1st water level this year. But with that said, I think this type of a market leads itself. I was talking to Jeff about this yesterday. I used this metaphor with talking with a client, I think last week or the week before, and it's when we sit down with all of you and we talk about your money and what's going on with the markets and any other questions you might have, I kind of liken it to when you feel like something's off health-wise and you go into the doctor and you say, something's wrong, you know, I'm worried it might be this, I'm worried it might be that, tell me, you know, what it is. And they come back to you and they say, hey, all your tests came back good. I don't really think this is anything. I think you just go home and relax for a week and you're going to feel better. And you say, that is not a very satisfying answer, doctor. You know, you almost want them to come up with some diagnosis for you. You don't want to be diagnosed, but you want them to have an answer for you. And their answer is, the best thing you can do is just wait this out, is just continue to do what you're doing and you'll be okay. And it's not very satisfying, but that's still the right answer. And I think that's where we're at this year, where I don't have a very satisfying answer for everyone. Oh, here's one thing we can do and all our problems are solved. I know exactly what the issue is. Here's how we fix it. It's more of a, we just got to keep doing what we're doing and things will eventually turn, as they always have in the past, and they always will at some point. So again, not the most satisfying answer in the world, but 2022, the market definitely made the naughty list. We do think going forward, there's a potential that it will not be a repeat next year, even though there are still plenty of challenges ahead.
Potential.
So what made the market go down this year? What were the factors that came into play?
Yeah, and actually, I'll kind of give you a preview, everybody, of I have a video on Thursday on our YouTube channel, which if you haven't checked out, just search Stein Financial Group YouTube and you'll find us. But I made a list of the naughty and nice things from the whole year, so not just the market and not just one thing. But to Jeff's question, definitely on the naughty list this year, and what contributed to the market not doing as well was inflation. And that happened both at the stock market and the bond market level. And I'm going to talk a little bit about the bond side of the equation, maybe more than normal, because that was a huge part of the story this year. Bonds aren't traded on the stock market. They're more conservative than stocks. And even this year, I'm going to talk about how they've done poorly. They still haven't done as poorly as stocks have. So they are more conservative than stocks. But on the bond side and on the stock side, inflation really caused problems. Two easy ways to think about it. One is inflation raised costs on everyone, all of us sitting on this call and every company in the United States. That means if costs go up, all of these companies become less profitable. In some cases, almost just like that, with the snap of a finger, they're less profitable. Now, they might still be making profits. They might still be a great company. But the stock market runs on how much money you make and how much money we think you're going to make in the coming year. And if inflation is high, that estimate goes down, and therefore the price of the shares goes down. So inflation on that side of things, even though I would argue Coca-Cola, for example, is just as good of a company today as it was a year ago, its stock price is lower than it was a year ago because their costs have gone up and their earnings really haven't as much as the cost went up. That's kind of a simplified version of it, but that's what drove a lot of the volatility in the stock market. On the bond side of the equation, very simple, the cure to inflation, or at least one of the potential cures, is raising interest rates. And raising interest rates wreaks havoc on bond markets. That's what we saw this year. That's what's happened. And that's why bonds are having, if the year ended today, their worst year on record. And this goes back to the 20s. Now, that doesn't mean they're down as much as the market is, but still, for bonds to be down high single digits, that is basically unprecedented for a full calendar year.
Yeah, I guess in the spirit of the season and the holidays, where it's not always all about the money per se, I guess I would just remind all of us as we reflect on a year of volatility that it still just comes back to our goals, our lifestyle, the wishes and desires we have with our accounts, our retirement, our lifestyle, and that, the day-to-day market volatility and why did our accounts go up and our accounts go down is important. But at the end of the day, we kind of circle back around to, all right, is the account still doing what we want it to do? Is it still going to provide for us long-term and the goals and the desires that we have set out? I think at the end of the day is what it really all circles back around to.
Yeah, I mean, and I'm assuming, Jeff, you maybe said something similar, but what I've been saying to everyone is the number one question you should be asking me is, it's not necessarily what the market's doing. It's not necessarily even what your account's doing, although you definitely should be asking us that. But the number one question you should be asking is, based on everything that's happened this year, has anything changed regarding my life? In other words, do I have to notice any of this? I know, Anthony, you're watching the markets for me. You're watching my account for me. Has this changed my ability to take money out when I want to? Or has this changed, the calculus on how long this pot of money is going to last in my retirement? And if the answer to that for anybody were yes, that's an immediate phone call from us, because that's the success or failure that we measure. It's totally important to have an account that continues to grow. That's incredibly important. But what it's the for sake of what we're doing it for, I guess is the way I put it, or for the sake of your life is why that account exists. So the fact that this year we've been able to say with pretty much 100% of our clients that your lives have not been altered by this rough market year. Your pathway, your trajectory has not been altered. That is, in my view, success, even in a year where the markets have not been cooperative. I don't know.
Well, I know the people on this call, when we have talked, the first thing you tell me is, what should I do? My money is losing value. It's going down. And we start talking and I give you an explanation as to maybe why. But then you come back to me and you go, you know, it really hasn't changed my lifestyle. I don't need this money. It's just there. It makes me feel better knowing that I have this safety net, things like that. But the bottom line is that this is an emotional hit, but not in quotes, a financial hit. And emotionally, it is a difficult thing to do, to look at your dollars. I look at my own accounts, they've gone down in value, but yet it has not altered my lifestyle. I still do stupid things. But what it comes down to is that.
What did he knock over? What did he knock over out there?
Is
What?
What did he knock over?
Nothing.
What was that noise?
I don't know.
is there a way to mute some of that? Or? But where we're at is let the money do its thing. It is set up in a fashion for everybody that we work with that is meeting at least what you've told us in the past your goals are. And if those goals are 5 years away, 10 years away, this is legacy money. Whatever is most important to you, I want to buy the cabin in 5 years. That's where we've constructed this. And we feel very confident that in the long run, things are going to work out just as we hope they will. And we do this every day, and our confidence level is high. And most importantly, we want to impart on you not only what our confidence level is, but how we would like you to kind of feel the same thing that we're coming across with here.
Yeah.
So.
Yeah, but as a reminder too, this is an open chat. So we're all on video and here to have an open chat. So if anybody else has anything to chime in with, just their own thoughts or questions, please definitely do. We can just keep the conversation
Well,
going.
you know, Art was nice enough to send us a question.
Oh, that's true.
So
Yeah, Art did send a question.
We should
That's right.
answer that. So do you recall, why don't you share what the question was, if you recall?
Do you have that one?
Is it too late to withdraw the question? I want to see you struggle some more. No, I appreciate it. Thank you.
Yeah. So I think the question was around using I-bonds as part of your tax refund and getting potentially like a physical certificate or paper for I-bonds as part of your tax refund, and if that would be a good strategy or how that might work. Did I get the essence of that question correct, Art? I didn't write it down verbatim.
No, that's exactly it. Our I-bonds, you know, the interest rate on I-bonds short term is very high. There is a penalty when you sell them, I think, in less than 5 years, but it's a small penalty. It's like 3 months of interest. Is that a good thing to look at? Not just for I mean, you could do a total of $15,000 a year. So it's not a huge amount, but you know, if you do it year after year, it builds up. Is that something that has gone from an okay investment back when they were paying 3% to last year, I think, or this year, I think it was close to 9%.
Mm-hmm.
Yeah.
You know, maybe you can talk a little bit about that.
Yeah, well, and it actually, I'll talk about that first, but it leads into an even bigger discussion we've been having more and more, which is what do you do with cash in general now? Because there's way more options out there than a year ago for a guaranteed rate of return that actually doesn't make you want to, you know, close your eyes when you look at your statement because you earned 2 pennies to rub together. But I-bonds in particular, I bonds, the I stands for inflation for anyone who doesn't know. And I know a lot of the people on this call do know, a lot of people on this call that I can see have I bonds themselves. And earlier this year, they were at an extremely attractive interest rate of 9.62% because inflation was so high. The I stands for inflation. The rate is going to be pegged to the inflation rate. So when inflation's high, I bonds make a lot of money. As Art mentioned, there are a couple caveats to be aware of with I bonds, and I'll talk about those briefly, but I bonds are still a great place to put your money right now. The rate has gone down a little bit. It's between 6 and 7% right now. I want to say 6.47, but it's definitely between 6 and 7. It's a little less. We anticipate that when they declare the new rate in April of next year, it's going to be even lower. That assuming inflation kind of continues to track in the direction it's going.
By the way, Anthony, is that for only new money, or is that the monies that I have in I bonds are going to now receive the new rate?
Yes, it's also the money that you have. So the way the interest rate works is every 6 months, the Treasury basically determines the new interest rate in the formula is based off inflation. So they're going to quote you the new interest rate in November 1st and April 1st, or excuse me, May 1st. End of April is when the new rate's set. And that's the rate you're going to get on any new money you put in or any money you have in there currently for the next 6 months, basically until the next November or May. And then the next 6 months goes with whatever the new rate they declare is. And the next 6 months goes with whatever the new rate they declare is. So in the past, when we've had incredibly low inflation, I bonds weren't on anybody's radar because they weren't making any money, or they weren't making enough to make it worthwhile. Now, with inflation being so high, it is worth being on your radar. And the caveats you need to be aware of, Art mentioned a couple of them. You can only invest a maximum of $15,000 per calendar year per person into I bonds. So if you're a married couple, you could each do 15. However, caveat within a caveat, you can do 10,000 purchased online, and that's at your discretion at any time. You just log on to treasurydirect.gov. You can go on, do it direct from the Treasury. That's the only way you can do it. This is not something we can do for you. You have to do it yourself because it's direct from the Treasury. You can do another 5,000 on top of that, but the only way to get it is through using the money you would get on your tax refund at the end of the year. It's kind of a convoluted process, which is why you may have heard that the maximum was 10,000. It's actually 15, but the process to get the extra 5 is, again, sort of convoluted. You have to pay in extra to your taxes, use your tax refund to purchase the additional 5,000 of I bond. So for a lot of people, especially earlier in the year when we were at that 9.62% interest rate, we said, just do 10,000 because it's just going to make your life simpler than having to worry about doing your taxes one way or the other. There's nothing wrong with doing the tax refund method. For me, it's just simpler to do the 10,000 from direct online. It's all digital. You don't have to worry about a paper certificate, any of that.
Yeah, because I was gonna say that you should clarify then too, because that other 5,000 is a little bit less liquid because now you're gonna have 5,000 of paper certificates and I bonds. So if you wanted to get rid of them, that'd be a little bit more difficult.
You gotta mail it in. It's totally doable. I'm not saying it's difficult. It's just extra steps. And I like the simplicity of doing things digitally. Maybe that's just who I am as a person, but the digital limit is 10,000 purchased out of your pocket per year. Now, going forward, do I still think it's a good investment? Yes, I do. Even right now, after the rates dropped from this past fall from 9.62 to, again, between 6 and 7 it is right now, that is still a very good rate for 100% guaranteed money. Definitely. It's really probably the best rate you're going to find for 100% guaranteed money right now. Art, you mentioned 5 years within a penalty. Really, the main one you want to avoid is getting out before the first year is up. You definitely need to hold it for 1 year. If you do hold it for 1 year and then you can get out whenever you want after that, and like Art said, you just give up the last 3 months of interest that you would have gotten. So that's usually not a prohibited penalty if you wanted to take the money out. You can, a lot of people don't know this, leave the money in there for 30 years. It's technically a 30-year bond that won't mature for 30 years. So you can let it run as long as you want. But after that first year, you can get it all out if you want to. So that's a key thing to know. It's 10,000 or 15, as we discussed, and you want to leave it for at least a year to get the benefit for it. Just as a follow-on, I was just having this conversation yesterday. Now that interest rates are higher, there are much better options out there for guaranteed rates of return, even some that are fairly liquid. For example, we've had a lot of discussions internally about just regular old treasury bonds, US treasury bonds. You can now get 1-year treasury bonds that are earning north of 4%. And one of the best ways to put that into practice is through what's called a bond ladder, which is very simply, you buy bonds that mature at different intervals, sort of as you're building up rungs on a ladder. So one that comes due in 3 months, one that comes due in 6 months, one that comes due in 9 months, one that comes due in a year. Right now, for example, the ones that are within that 1-year time frame are 4.6% is what they're earning in interest. Two benefits, well, more than two benefits, but two big benefits. One is, as long as you hold those bonds for their maturity dates, so you hold the first fourth for 3 months, second fourth for 6 months, you will guaranteed get your money back plus interest. These are US Treasury bonds. They're guaranteed by the federal government. If you look at your statement on any individual day, they will have a market value. But the only market value, the only thing that means is, what if you wanted to cash out today? Which you can, because they're liquid. So one of the big benefits is, if the bond market does what it did this year, let's say, and doesn't do well, you don't have to care, because you're getting your interest and you're guaranteed to get paid back everything you put in within 1 year. If the bond market does really well, for example, let's say we cut interest rates at some point in the future, those bonds are actually going to go up in value, and you could cash out early at a premium. That's something that's very different from a CD at the bank, where yes, you're locked in for a year. Yes, it's all guaranteed, but you don't have any upside with that. You have what you're guaranteed. With a bond ladder, you have no downside as long as you hold for a year, which if you were going to get a CD, you were going to do anyway. But you actually could have upside if interest rates get cut. Now, I'm not saying I'm planning on that happening. I wouldn't factor that in. You do it for the interest rate. But there is an added layer of benefits to doing something like a bond ladder. And the reason why you're hearing about this maybe for the first time is interest rates haven't been high enough to make this worth it for the past decade plus. I mean, now we're finally at a place where this is a viable option that's earning, like I say, north of 4%. So I'll get off my soapbox there. You've listened to me talk enough, but that was a long answer to Art's question.
Yeah, but it's fun that the environment is finally favorable for the bond market. So we can have some different alternatives and different options to present to clients and folks about, like, what do we do with our cash? Because I think everyone is incredibly tired of only getting 0.01% at the bank for their savings account and for their cash just sitting there. So it's fun for us to be able to have additional options and opportunities to present for people to put their money in, whether it be I-bonds or the ladder bond strategy.
So
Whatever
both are
those
good
might be.
options.
Mhm.
CDs are good options too. I'm not here to
Yeah.
poo-poo CDs. CDs are great right now. They're earning about the same. There's just other things that are similar to CDs as well.
Yeah.
Questions?
Yeah.
Is
I
there-
have a question.
Go ahead.
That's the same chat from.
Oh, okay.
Sure. I was going to ask a question. Is everybody done with all of their holiday shopping, or do people do any holiday shopping this time of the year? Anybody still have something on their list they still need to shop for? No, everyone's good. Oh man. Okay. Well, then maybe my tips and ideas will be of no value. And then as a reminder, for those of you doing your RMDs, you can gift those to charity, which I know a lot of our clients do that already. So that's a great way to also give during this holiday season if you don't need those RMDs. But also you could think about, in terms of your legacy, maybe you just want to start gifting some of your legacy to your kids now. And maybe there'd be some really good tax advantageous ways to do that, especially if we've had any losses in your accounts or anything like that going on. You can gift up to $15,000 per person or up to $30,000 as a couple every year. So maybe you would just want to start some of your legacy gifting now, and you could gift them some physical stock instead of buying Christmas presents or holiday presents or anything like that that you might be doing this season. So just some fun ideas to think about and different ways to gift during this time of the year. I thought I'd share them.
Yeah, well, that I say this all the time. Probably a lot of you have heard this from me, but I really like finding a way to do those legacy type things while you're still around to see the smiles on the faces of the people who you're helping out. So that doesn't have to be just cutting somebody a check and watching them just say thank you. But we've got a lot of great ideas from people who they sit down every year and they go through their charitable giving together as an extended family, and the grandkids write in, what they would like to give some money towards out of the family's pot. People go on trips, people just spend the holiday time together. It can be whatever you want it to be, but do it now. Use the money now versus just leaving a pot for once you're no longer here. Not that that's bad. I just like doing it while you're around better.
I think you did good.
Yeah.
Those are.
Can I add something to that?
Yeah.
I'm retired now, but I did estate planning was my business. And I can't tell you how many clients, when I got the idea from Jeff originally, and I really kind of pushed it with some of my clients, and they were so happy to be able to do some things. Particularly one who was quite wealthy and gave some money to the University of Minnesota for some medical, and actually saw some positive results before she passed away.
Oh, that's awesome.
That was, in the area of macular degeneration, and she was blind from macular degeneration. And I'm not saying you have to do anything that big, but the idea of doing it while you're alive, whether it's charitable or to children or nephews and nieces or whatever, really does make a lot of sense as long as you're comfortable. As long as you're not worried about your own security. You don't want to give too much away. You never want to have to ask your kids for money. But if you're comfortable about it, it's wonderful to see somebody enjoy seeing the fruits of their generosity or their labor, or however you want to put that.
100%
Absolutely,
agree. Yeah. And to your point, Art, it's always a balance between doing it, giving away what you can without penalizing yourself in the future, giving away too much too soon, maybe. And if you're worried about that, anybody, that's our job to stop you from doing that. So I love people who come in with the generosity, and it's my job to crunch the numbers and say, yep, that works, that makes sense, that's totally doable, or okay, I see what you're doing, I love it, let's tone it down and do it over. That's my job, to break all the numbers down. You come in with the ideas, you come in with the checkbook ready to go. I'll tell you, how much to write in the call or the pay to line.
I love that story, Art. Thanks for sharing that. That was a great story.
So
Yeah.
Well, I don't know what our timing still is, but one of the things that I think I'd like to leave with the people on this chat is just what is causing some of these things this year, because I don't think it's doom and gloom. For example, I just read a great article on inflation, especially things like food inflation. And the biggest issue is that we used to think inflation was being caused by supply chain issues, and some of it is, but the real problem is us. And I guess if you look at it in the right context, the reason that we're driving inflation is that we still have money and we are still going out and purchasing. And by going out and purchasing in the fashion that we are, what's happening is that we are driving up those prices. So if almost everybody on this call is from the Twin Cities, you come to the Twin Cities and let's say you go shopping at Barley's and you want to buy some ground beef. Well, so many people are buying the ground beef, the demand is up. That all these things are happening, and because of that, Bartley says, "Oh, we have much more for that."
Yeah,
And that's exactly what's happening.
right.
So we are our own worst enemies per se, as would relate to this inflation type of issue that's taking place here.
Right. So following on from that, I just made a video today, which will go up next week, about an article that I saw on CNBC. It doesn't matter the source because it's objective data, but it was about for people over two things: inflation and Social Security, which, by the way, for everybody who's on Social Security, we get a nice increase next year. We thought last year's was big. It's 8.7% next year. So happy 2023, everybody. I think that's one of the best holiday gifts you could get. But the other part of the article was about what individual items went up in price the most this year, especially for people over 65 or people who are on Social Security. That was the thesis of the article. And I was very surprised. So you could probably guess what the top two were. Number one was
Eggs.
Eggs actually, I
I
think
paid $5.50 for a dozen eggs yesterday.
that's
Oh my gosh,
unbelievable.
I agree, Ann. I've been buying a lot of eggs the last couple of weeks in preparation
So
for
you
the holidays.
don't think the government spending has caused inflation? Do you watch the news at all?
Well,
I watched
There's still the COVID package, they still haven't spent it, but yet they keep passing bills or more spending packages.
so I would say two things. I'd say you're absolutely right that the
Thank
stimulus
you.
that we issued in response to COVID, it's sort of we're dealing with the side effects of the cure to the COVID, what could have been a recession and was a recession, but a much shorter one than it could have been. But I will say 70% of the economy at this point is still the individuals, all of us, the population. So the government has a large impact, a more than a quarter usually impact, depending on how you measure it. But us as consumers have 70% of the impact all in our hands. So I'm not saying I think it's.
But then I want my money back so I can spend it the way I want to. There's still money that they set aside to protect the kids in the schools. All the schools are back, but yet they still have money set aside to do the air systems at schools.
Mhm.
There, in that first COVID package, which in the beginning, everybody was full tilt for it. We got to do that. But there is like $1 trillion of it that hasn't been spent. But yet they are going to pass this week another spending bill. And it's like, you need to spend the money on what you have already set aside.
Right. And
I can't do that with my budget.
Yes.
I would like to.
I think everybody knows, including the government, although they don't seem to have any interest in stopping it, that the amount of spending we do at this country is unsustainable. Forget about inflation. Forget about this year, for example. We have a deficit and a debt that continues to grow. Now, there are so many different topics we could go into on deficit and debt, and almost none of them are fun to talk about. But to your point, Ann, I think the stimulus that we put in place and is still in place, to your point, based on the pandemic, is partially and to a large extent, maybe not even the majority, but a large proportion of what's causing some of the heartburn that we've had this year. We're kind of paying the piper for the strong recovery we had in mid 2020 to mid 2021 to get out of the hole we were in. It's sort of, it's a double-edged sword. You know, it cuts both ways is the problem. And we're dealing with the backblow of that right now. We did have a question, and I want to get to that list I was going through, because we did have a question about what the actual top items that increased in cost. Number one, by a landslide, was heating oil. increased by 68% year over year, according to this article. Number 2 was airfare. That actually increased more than any food item or any other energy item except for heating oil. Now, number 3 surprised me. And you kind of hinted at this, and I think 5 or 6 out of the top 10 were food items. And number 3 was flour or baking mix. That was the 3rd biggest price increase year over year in 2022 for people over 65. So I guess A, that speaks to everybody's baking bread, but B, that shows you what consumer demand can do for a price. Like Jeff was saying, they can afford to raise prices because flour was selling out like crazy. By the way, that came in ahead of number 4, which was health insurance and healthcare premium. That actually increased in cost less than flour did last year.
But it's not all demand. When you look at the farmers, what they're having to pay for fertilizer and to truck in water and stuff like that, that has nothing to do with demand.
Right.
That has to do with sustaining a farm.
Yes, and the cost, and that's a great not segue, but that's a great point, I guess is what I'm trying to say.
That has nothing to do with demand.
Right. And that's one of the reasons why this year has been such a challenge for everybody, not just farmers.
And ground beef.
Right.
You're looking at cattle. You're looking at feeding the cattle. You're looking at transporting them to fields where they can get grain or selling them off before they're fattened up. That has nothing to do with demand.
No, it doesn't. And the cost side of the equation, which is what you're getting at, is one of the big problems for all companies in the stock market and all individuals who run a business like a farmer runs their own. You wouldn't call it a business, you'd call it a farm. But my father-in-law, who we're going to go see this weekend for the holidays, has a herd of beef cattle. And so they deal with that reality, every day. And we'll go see him on the farm this weekend.
Yeah, it's just amazing how there's everything is intertwined. Nothing is not dependent on another piece of the puzzle when it comes to our economy, because it's all so interconnected. Every component of it is all definitely interconnected and impacts each other in how it works.
I watch the Financial Channel a lot, and they said it is now cheaper to go out to eat than to cook at home.
If you can find somebody to serve you.
Yeah.
They have to increase the cost of the food just to pay for labor. Because we just talked about, all the different cost components start to come at us from many different ways and many different sources. For sure. But I do think the most fascinating point, though, is what Anthony said, is that health insurance and healthcare was not number 1.
Yeah.
Because that has been for a decade the top fastest increasing thing, maybe besides the cost of higher education, in terms of how fast and rapidly costs are increasing. So that in itself is fascinating.
Yeah.
That health insurance ended up number 4 on the list. I think that's incredible.
Yeah. By the way, just as a follow on to the Social Security piece, I also learned in that article, I'm not on Social Security, so I don't get the letters that they send every month. But everybody, if you haven't already who's on Social Security, you should be getting a letter, if you haven't, that'll say what your check is going to turn into next year. So that's a fun letter, if you haven't gotten it, that you can look for in the mail here in the next couple of weeks.
And yeah, so if you're going to get any news from the government, that's going to be the most exciting piece of paper to look forward to, right? All right, well, we're kind of wrap up our coffee chat here, but does anybody else have any other questions or anything else on their mind they want to chat about here today?
I have a question.
Yeah.
You mentioned $15,000 that we can give each per year.
Yep. For I-bonds. Yep.
When I read that, it looks to me like you can give 15,000. I could give 15,000 to 2 people each. Is that the way? Am I reading that wrong?
Per person. Yes. Right.
Per person, I can give 15,000. So I can give.
You're talking about the gift. I'm sorry.
Yeah, every year you can gift up to 15,000 tax free. And you can. The reason I said 15,000 because at the 15,000 level, you don't have to do any tax filing. If you want to give more than 15,000 to like more than one person, for example, or anything like that in 1 year, you absolutely can, because you can gift up to the lifetime gifting value, which is currently at like 11 million or something like that. So it's very high. It's very, very high. But if you gift more than 15,000 in 1 year, it does require additional tax filing, so that the IRS knows that that gift is going towards your lifetime gifting total, and it's not part of just your annual gifting total. So that's the only reason why 15,000 is sort of like the easy number, because then it doesn't require any additional work. But
Yeah.
it is 15,000 per person.
Yes.
So like if you're a married couple, you could each give 15,000. So then that would total for 30.
Okay, that didn't answer my question, but.
Well, in 1 year, unless you want to file the
No,
tax.
Yeah.
If you had 10 kids.
Oh,
Yeah, so
Each one can get 15,000.
yeah.
Yes, but you still have to file the tax paperwork, because then within 1 year, you've gifted more than your annual gift minimum. That doesn't require additional tax filing paperwork, where you have to declare that that's part of your lifetime gifting value. So the 15,000 is just an easy number, but by all means, you could give 15,000 to all 10 kids if you wanted to in 1 year, for sure.
Yeah, I thought you were talking, Mike, about I-bonds again, because that was another $15,000 number I said, so I muddied the water when you first.
I do have a question on I-bonds.
Yeah,
It looks like it's per fiscal year, so I could buy 10,000 this month and 10,000 per calendar year, excuse me, this month and
Yes.
next month, and still be, okay, that
Exactly.
is correct then, huh?
right, it is correct. Also, a lot of people, there actually is a best time to buy I-bonds, in my opinion, that you don't get an advantage other than time. The best time, in my opinion, to buy an I-bond is the month before the new rate gets announced. And the reason for that is, from the day you buy it, whatever the rate is declared on the day you purchase it is what you get for the first 6 months, even if the month rolls over the next day and there's a new rate. So in other words, if we're between 6 and 7% right now, if you buy your I-bond on April 30th, you get the rate that's declared today for the first 6 months, regardless of what it turns into in May. And then you get what it turns into in May for the second 6 months. And the reason that's advantageous is, the longer you wait, the more likely you are to have a pretty good guess as to what that next rate is going to be. So you have the most possible advance notice of what your full 1 year of interest rate is going to be. You don't actually get a higher rate because of it, but you are more aware of what the next rate is going to be and why that would be important. Let's just say, hypothetically, I think this is unlikely, but let's say inflation really gets under control over the next couple months, and the new I-bond rates in May are going to be 2% or something like that, or that's what they're projected to be. It would be nice to know that that was the case before you lock yourself in for a year. And the longer you wait, the more likely it is that you'll know what that next rate's going to be, or close to it. That's why I say that. But your question is absolutely right. It's per calendar year, meaning you could buy 10,000 electronically on December 31st and 10,000 on January 1st, and you're totally in the clear.
Yeah, awesome. Well, if nobody.
Can I go back real quick to
Yeah.
the gift tax exemption? It's actually 16,000 in 2022. It had gone up,
Yeah,
and in 2023 it's going to go up to 17,000.
Thank you, Art. I kind of was thinking in the back of my mind it had gone up. Thank you.
Yeah, it did go up.
Can I ask a question?
There he is. I see Steve with the Santa hat on, looking good.
Hey, I like it.
Sorry, anybody else, any questions? I distracted us.
Well, there aren't
Can
any.
I ask a question?
Yeah,
One, can you, do you happen to know off the top of your heads, if you hold the I-bond less than a year, what's the penalty in that event?
I will double check it for you, Bill. Maybe even Art, I believe you forfeit all your interest. You don't lose anything, but if you don't hold it for the full first year, you lose not just the last 3 months of interest, but the entirety. So if you hold it for 11 months and 29 days, I believe you lose all your interest for the year. I will double check that for you though, Bill. That's just from memory.
I think that's what I heard.
Another question I had was, when we talk about inflation and we talk about fixed basket of goods that goes into the calculation, is there anything that accounts for consumer choices moving to less expensive items in the theoretical basket, or just to something
Right.
less expensive, period?
Right. So I can only give you the short answer because the long answer would take me another hour to explain. But the
Okay.
short answer is no. When we measure what Bill's getting at, everybody, is, and this is sort of a pet peeve of many economists. This was a pet peeve of all the people I went to school with when I went to school for economics. The way we measure inflation is based on literal survey taking of items and goods in our economy. People go out to grocery stores literally and look at what the prices are, and they track them over time. It has no metric or data for how demand is changing. It has no metric or data for how life is changing. For example, one of the big issues people have with the way inflation is tracked is computers, which tend to get less expensive as time goes on, are not factored in probably the way they should be to our inflation numbers. So I could go on, but it would take too long. Well, I guess my answer to that question is inflation, the numbers we get, is a very imperfect number. It is still a meaningful number. I don't want to tell anybody that it doesn't mean anything. It absolutely does, and that's why we use it.
What's your schedule look like?
The what?
What's your schedule look like? When do you have that hour to go into it all?
Maybe we'll have to do an event out of it at some point.
Or,
Okay.
I don't know if everybody knows this, but Anthony does just an open off an hour once a month.
That's true.
That he can just chit chat on whatever he wants to. So Bill, you might have to
Oh,
take it.
yeah. Okay. Yeah.
Yeah. So every first Wednesday of the month, if you're in Minnesota, you just have to listen for the tornado warning siren to go off, because that's when I'm on my office hours. And it's a Zoom meeting. I just sit there. If somebody logs on, we talk. If nobody logs on, that's fine. I'm just working in the background anyway. But it's an hour dedicated to whatever anybody wants to ask me. So if you're interested in that, sign on. Jeff, by the way, quick looked at the answer for that I-bonds question. You cannot cash an I-bond out before 1 year. It's not that you forfeit the interest and get your money back. You cannot sell it. It is not allowed.
Okay.
And you're dealing right with the government, so they're just not going to give you the button to sell it. There's nothing you can do. So that good Googling there, because my memory was slightly off on that. But we're probably about time to wrap up. Everybody's been really patient. I know Kim's got our giveaway.
Yeah, we have to end every coffee chat to see who gets some coffee. So we'll just head over here really quick. And we'll hit the button and see what we got.
All right, it's your lucky day, Dave.
Woohoo! Yay!
Coffee was not in the top 3 of the things that got more expensive, so we're not breaking the bank to get you some coffee, Dave.
Actually, we just want to wish all of you a very
Yes.
happy and healthy holiday, Christmas, Hanukkah, Kwanzaa. Just enjoy the new year, and looking forward to talking to you if you don't reach out to us individually after the first of the year here.
Yes, absolutely. Happy holidays, everyone.
Be good and be well.
Yeah.
Thanks.
Thanks, everybody.